Thank you very much, Johnny. I'd just like to thank you once again for joining us this morning. We do appreciate you are quite busy, and obviously on a Friday morning, presentation can be quite tedious. So what I'm trying to do today is to impart a little bit of my enthusiasm for fixed income. Fixed income is quite a difficult and complex little beast. So hopefully when I leave today, you will feel as enthused and as interested about fixed income as I am. Just to touch on the agenda, I'm not too sure how familiar you are with the process. I just want to take 2 slides to explain the process, take a fly through what we actually do, how we actually structure our thinking, because as you see in later slides, it's quite cyclical. And fixed income, the returns are fixed. So if you buy a bond, you're buying a fixed return. If you hold it to maturity, you know exactly what you're getting. So you need to be quite clear about why you're buying the bond, and you need to be clear about the risks that you face. And to illustrate a little bit of the risks that we face, I will touch on inflation and growth. We're currently in quite a strange set of environments where we have low growth despite the monetary stimulus that we've seen, and we also have low inflation. We'll touch on why that is, and hopefully we'll try and get some clarity on that. And thirdly, I just want to then touch on policymakers. What are policymakers doing? How are they addressing the challenges that we face? And we'll see how difficult it is even for them. And fourthly, like Johnny did, we'll bring it all together. How do we actually think about this? What does this actually mean? So, when I say, I think we're in a low growth, low inflation environment, what does that actually mean for returns that you expect? And we'll finally close off with a slide on the performance. So, I mentioned the process. Very easy. This is just a skeleton of the process. I'll spend a few minutes putting some skin on it. Our process can be summarized in 4 stages. Analysis of value, stage 1. Johnny mentioned that we are essentially prudent value investors. What does that mean in fixed income? Well, let's think about our universe. Our universe is essentially lending to governments and lending to companies. Both of those might sound quite similar. They are, you get a fixed return, but the risks are slightly different. And we'll take a look at why the risks are different and how you actually can, through prudent risk management, reduce your exposure. And secondly, we do some work on confirmation of value. What does that mean? So the money that you give us, right? There are competing assets in the world, so we actually have to sit and think about whether the best way to invest your money is to actually invest in some of the things that we think are good value. So we do a lot of research. We focus, especially on the company side, we focus a lot on whether companies will be willing to, will be able, hopefully willing, but will be able to pay us back when the bond comes due. So we do a lot of credit work, we do a lot of macro work, we try and understand where we are in the world. Lenny mentioned, we don't do forecasting, but you'll see in a few slides' time, it actually matters where you are in the cycle. Third stage, portfolio construction. I mean, that is just, it's a technical term. We actually love it. It's just a technical term for putting together the building blocks. What are you actually doing? You're putting together the building blocks of a portfolio. But you need to do it in a sensible manner. I mentioned risk management. Risk management is key, especially for fixed income. You need to do it in a sensible manner that makes sense, that helps us achieve the goals you set us, and hopefully beat those goals. So portfolio construction, very key. Fourth stage, monitoring and control. So once we've bought the assets, we don't just forget about them and go sit on the beach, as tempting as it might be being in Cape Town. We have to go look every single, on a periodic basis, you have to evaluate exactly why you're still holding the investment. Does it still make sense? Has the valuation reached a point where you don't want to hold it anymore, you think it's expensive? And also, are there any risks that have emerged that weren't there at the beginning? So stage 4, stage 3, actually interlinked, and to us, the same process, but the stylized version gives you an idea of how we actually do it. So let's jump into this universe of it. I mentioned we essentially do 2 things. We lend to governments and we lend to companies. A government has its own set of risks, primarily inflation risk. So when you lend to a government, in order for them to pay you back, they have the luxury of being able to tax us, and also the luxury of being able to just print money. We saw our neighbors up north. Printing money is not a good idea for the value of your currency, so you have to be quite cognizant of that risk. So what am I showing you? The gold line is essentially the return you get for lending to a government for a specific term. Okay? We call that a yield curve. That is what you get. So, for example, if you lend to the government for 3 years, you're bound to get between 7.25% and 7.5%. If you hold that bond to maturity, you will definitely get that return. If you lend to government for longer, for 10 years, for example, you'll get north of 8.5%. So you get rewarded for lending for longer. That means that there's higher uncertainty of inflation. Right? So when you are lending for a longer term, you get rewarded for taking the term risk. The term risk is characterized simply by inflation. You have inflation risk, especially in the nominal bond space. And when you think about it, you're lending to the same entity. So why is it that you get rewarded a bit more for lending to them a bit longer? And in our minds, that is simply because you get rewarded for inflation. And the second thing we do, the dots above the yield curve are the returns that you get for lending to companies. And we've essentially split them up into AAA rated, AA rated, single A rated. All the ratings mean different levels of risks. So a single A rated company, something like ABSA, everyone knows ABSA, it's a blue chip investment, it's a blue chip company, and you're quite sure they'll pay you back if you lend them money. As a result, the green dots, even though they're higher than the yield curve, so they're higher than lending to governments, are not as high as the other dots. So that tells you something else. Why are you getting rewarded for lending for the same term? Why are you getting rewarded a bit more? And that is credit. So credit, simply put, is the risk that whoever you've lent to will not pay you back. So when you go to your bank, you look for a mortgage, your bank will do a number of assessments. They'll see whether you've got cash inflow. Unlike in the United States, just before the crisis, they were issuing out ninja loans. We know how that turned out. So a good bank will try and do some credit work. We do exactly the same thing. And as a result, we have a wide spread of assets that we can invest in. But in order to manage that risk that one of these companies might go bust, you need to also employ diversification. Diversification is one of the only free lunches there are in the world. So if you spread your risk across a wide number of names, you will get decent return without taking a lot more risk. Okay, so we do inflation, we look at what we're getting paid for inflation, and we do credit. I think I've beaten that horse. So let's look at inflation. What has inflation done over time? So we went back the last 15 years, and we looked at the annual rates of inflation on a monthly basis. There's quite a lot of data points, but essentially we then plotted for each country on the vertical axis, the inflation rate. The dashed line gives you the range of inflation rates over the last 15 years, while the block gives you 2/3, most of your observations, right? And we did this for a number of our key trading partners, so we split it up into advanced economy and emerging economies. South Africa is a part of the emerging economies, and just a broad stroke observation, emerging economies typically sit slightly higher, they experience high inflation, while advanced economies, for structural reasons, will have low inflation. But you'll see, take a country like China, for example, the range is quite wide. They've gone from low to mid single-digit inflation rates to negative inflation rates. But when you look at the actual 2/3 of observations, it's actually come down. So they're transitioning from an emerging economy to an advanced economy. Right. And the dots are simply the latest inflation prints that we've seen. So I mentioned in passing earlier, we've had tremendous amounts of money pumped into the system. by these economies, obviously to shore up the system after the great financial crisis. But the biggest fear was that this stimulus will lead to runaway inflation. So people in the US were quoting inflation rates of 10%, which they've never seen before, well, in the last 30 years. But the big fear was that inflation will come. That's not what we see. The red dots are sitting predominantly below the bottom half of the last 15-year range. So we've had all this money being pumped in. You were getting paid some interesting yields for taking duration, but inflation hasn't arrived. This is the sort of thinking that we're into. We look for assets that, despite the risks that we know, the risks that we don't know, you can't forecast everything, you can't think about everything, but for the risks that you know, you get compensated. So what I want to leave with you is that inflation at the moment is sitting at the lower range of our, recent expectations. And we did the same thing for the same group of countries looking at GDP. You can't think of inflation without thinking about GDP. Theoretically, it's a Phillips curve. You can't have the other. It's a trade-off for central banks. But effectively, same sort of picture. Last range over the last 15 years, 2/3 of observations, and the last inflation print. So this picture is slightly different. I hope you noticed. The emerging economies, like the inflation story, are sitting at the bottom range, the bottom half of the last 15 years. But advanced economies are sitting at the top half. So something fundamentally different is happening. And we'll see in 1 or 2 slides why that is. So the stimulus seems to have worked for advanced economies because their growth rates are slightly higher. It hasn't filtered through for emerging economies, despite the stimulus being passed on. So, if you print money, you give it to a bank, what is a bank going to do? If they're worried about the globe, they won't invest it. They go and buy assets. So we've seen immediately after the crisis a massive drop in the dollar, in the value of the dollar, and that is people going out and buying, securities, bonds, equities in countries like that. So that clearly hasn't helped. It hasn't helped GDP. It hasn't helped inflation. It has helped GDP a little bit for advanced economies. So we are actually in, I hope it's coming through quite clearly that despite central bankers' efforts, we're actually in a quite an interesting and challenging environment. So being a bond guy, I'm quite worried about risk. I went back and said, okay, so what are the scenarios that we're worried about? So we went back a number of years and we looked at what global bonds have returned. We looked at global bonds purely because the data is quite extensive and available. So we went back and said, okay, we'll split the world into 4 quadrants. We'll look at inflation, starting from a low base, rising and falling, and we'll look at inflation starting from a high base, rising and falling. And what does that mean for our returns? Then we went back and calculated the average return you have in each of these periods, and there is quite a convincing cyclical element to it. So where you are in the cycle matters. And I mentioned earlier, you need to be quite cognizant of where you are in the cycle. But the second point that's coming through on this chart quite forcefully are that your returns in each of these periods are quite different. So it's quite important to know where you are in the cycle, and it's quite important to know which assets to pick. So, for example, currently, inflation has been low. It's not rising as quickly as everyone would like. It's low, and that is why bond returns have been good. We've done quite well on bond returns. Global bond markets have also done well, and that's the average return that you would expect. Clearly, if inflation is high, it's not great for bonds. So it's quite important to know where you are in the cycle. It's quite important to know which asset classes to pick. Now, we've looked at where we are in the cycle. Obviously, the next natural question is asking, where could we go? So, once again, I just want to go back to the US, fly over a little bit, and we looked at what does inflation do? What's the relationship between inflation and unemployment? And it's quite an intuitive equation to think about. If there are more people who are unemployed, there's more competition, which means that wage inflation, so people go to work, work, in a year's time, ask for a raise. if the number of people who are unemployed is high, then wage inflation is relatively low because everyone is willing to work for a little bit less just to get a job. So on the y-axis, or the vertical axis, we have a measure of wage inflation in the US, and on the x-axis, we have a measure of unemployment in the US. Okay, so high unemployment, relatively low wage. Is that the case? Turns out that's the case. So the relationship between the two is effectively zero. Right? Your periods where inflation is low coincide with periods where unemployment is high. So what happens when unemployment is low? Lo and behold, we actually have a slightly different relationship. So once again, where you are on the cycle matters. So in this picture, the gray dots, when unemployment is low, fewer people are looking for a job, which means the employee actually has pricing power and can ask for higher and higher wages. South Africa is slightly different. Despite the high unemployment that we have, wage inflation still skyrockets. So, getting back to the US, low unemployment, high wage inflation. So where are we at the moment? We took the last 5 quarters that we've observed, and there seems to be a migration out of this period of low unemployment, high unemployment. We've seen unemployment rates coming down in the United States, and we've seen wage inflation. I'm not saying as a result, but coinciding with increasing periods, well, periods where wage inflation is increasing. So it's not clear to us where we are headed. We'll see in 2 slides' time. Even the Federal Reserve is not sure what's going on, but the evidence is a little bit interesting to us. Now, I mentioned the US dollar. So I've given us the good news. Good news, wage inflation might come. Wage inflation coincides with periods where the world is prosperous. Okay, let's look at growth. So we then went back. Someone mentioned to us, Johnny actually mentioned the high drop in the very, very big drop in the price of oil. So the red chart is a year-on-year change in the price of oil, and it's on the right-hand side axis, and we flipped it over. So the chart going up means that oil price is dropping. And the chart going down means the oil price is increasing. Okay, and over that, we overlaid the growth rate of the group of 7 advanced economies. These are typically, or have been typically, your biggest consumers of oil. So the compelling argument that can be made here is that when you have large increases or decreases in the price of oil, it has an effect on growth. So we haven't seen growth, but we've had the massive decrease in the price of oil. We expect some boost from the drop in the price of oil. How much, we don't know. But if you look at this chart, it tends to be quite good. So the good news, wage inflation could come. It's starting to rear its ugly head. We don't know. And growth might come. Simply a boost to consumption, a boost to incomes, but also a boost at a GDP level. But what are the risks? So I mentioned the Federal Reserve. Federal Reserve is the equivalent of the South African Reserve Bank in the US. They meet every 6 weeks, just like our Reserve Bank meets, except they meet every month, every 2 months. They meet every 6 weeks, get together and look at the data and decide how they should respond to the data. Out of those meetings, you get submissions. So each Reserve Bank governor, there's 17 of them, each Reserve Bank governor will say, I expect our repo rate to be at 1% over the next year. They do that across the 17. What's interesting is the wide divergence in these expectations. So the dots represent the expectation of the Federal Reserve Bank governors for their repo rate over the next 3 years. Okay? They have access to the same information. They have big teams of researchers and economists, yet they expect wildly different things. That's a risk. The market disagrees with them almost completely. So this red line is the market expectation of US repo rates over the next 3 years. And if we overlay, so if you just take a median, if you take the combined value of all of those dots and average it out, you get that gray line. So the market and the Fed are disagreeing. The market doesn't think the Fed can veritably get rates up to 2% over the next 18 months. That means there's a risk. So who's right, the market or the Fed? We're not too sure. But also, it also raises a second question. So if the Fed is right, and we all have to reprice our expectations, all we, being the market, have to reprice expectations, it's bad for bonds because it means yields are going to go up, price goes down, we make a loss. So wide divergences in expectations create volatility. So that's the bad news. Bad news number one. There's volatility coming up. We're not too sure when it'll hit, but repricing has to happen. Bad news number two. Even though you have the Federal Reserve, arguably the most well-informed central bank in the world, with teams and teams of economists and researchers, the yellow line is where they expected their repo rate to be only 6 months ago. So they've changed their minds quite drastically in 6 months. It's not their fault. They know what they're doing. They're very smart people. But it just highlights that if you take into account the data, you have to change your expectations quite rapidly, which means the data is changing quite rapidly. So not only do we have a divergence in expectations, but the data itself is changing so quickly. So risk number one, bad news number one, there's volatility. Volatility is not necessarily a bad thing. It's a good thing. If you have powder dry, you can take advantage of it. But it is a little bit uncomfortable when you're sitting on positions that you know are right, but might be loss-making in the short term. Bad news number two, the US dollar. So why should we, as a small, open economy, pay attention to the US dollar? Well, for one thing, the US is the world's largest pool of private capital. So people like ourselves in America have mandates to invest across the globe. And obviously, when they invest, they have to exchange their currency. It has an effect, and at a macro level, they are big suppliers of capital. So South Africa, case in point, a country with a current account deficit. Who helps us fund it? These flows do. So the picture I wanted to actually highlight on this page is the top right chart. So that is the dollar index, which is essentially just the value of the dollar against the basket of trading partners over time. And I don't know if you've seen in the news or if you've traveled recently, it's quite expensive to travel. And that is because the dollar has appreciated by over 25% in a very short space of time. And people who study markets might say, you know what, a 25% move in a very short space of time, there must be a reversal. It's not sustainable. So we went back and looked quite far back in time. And you have periods where the dollar can appreciate for over 4 years. That is painful. The last time we had a similar period was 1994. I was too young then, so I wasn't in the markets. But people who were in the markets will tell you it was not fun being an investor. It was massive amounts of volatility, massive amounts of losses. People lost money, companies defaulted. It wasn't a great place to be. So a word of caution that keeps us quite vigilant is that despite having this 25% appreciation, it could go on. So what does that mean for South Africa? Well, when a currency appreciates, one currency has to depreciate. So you take the dollar-rand exchange rate. This picture, if you draw a chart of the South African rand, it's the inverse. So when the dollar's appreciating, the rand depreciates. And that has an immediate impact on our inflation. Right? Coming back to inflation. Being a bond guy, inflation is bad if I'm holding a position that is not compensating me. So when the dollar's appreciating, the rand depreciates. Now, the Reserve Bank might say to you, we don't target the currency. We focus on what the economy is doing. But I can tell you now, if the rand halves in value, inflation will go through the roof. How are they going to respond? And we'll see on the next slide how the market actually prices for that and what the market is actually thinking the Reserve Bank's going to do. So when the dollar appreciates, the rand depreciates, immediate impact on inflation, which is bad for us all. So let's look at what inflation has done over time. Let's look at what people expect. So the red line, core CPI. So that is the first chart on inflation, those bars. That is the bar over time, but stripped of volatile items. So core CPI measures the underlying inflation in the system. The gray channel is where the Reserve Bank would love inflation to be. If inflation is within the target band, they're doing a great job. They can sleep easy at night. But we've seen there are periods where inflation spends a very long time outside of the target band. And as a result, you have inflation expectations, being the gray line, remaining also above the target band. So, the SARB is also a very credible central bank, but the data and the people's experiences in the market says to us that the market is a little bit circumspect that inflation is actually here, inflation is over there. Okay, so the gray line, economist expectations of inflation, and the gold line is the market's expectations of inflation over the next 5 years. Now, that gold line is a little bit misleading because it's quite high, so you might ask, well, what does that mean? Inflation break-even is high. So people are saying that inflation over the next 5 years will average 7%. We've recently done a trade where we almost disagree with that, and part of what you're getting paid in that gold line is a risk element. So the market expects inflation to average 7% over the next 5 years. That is very high. So what does the SARB do? I mentioned a lot of this was driven by currency weakness. So if the currency goes, the dollar carries on appreciating, the SARB will have to respond. That is big risk number 3. So being a bond investor, went back and looked at what do bonds actually do when the SARB starts moving. So this busy chart, each of those lines represent, we took the bond yield at the start of the hiking cycle, and we took the bond yield successive months and prior to that, and then we looked at where the bond yield ended. So when bond yields go down, we make money. It's the inverse of the equity world that Johnny told you about. When bond yields go down, it's a good thing for bonds. So each of those represents the last 9 cycles, including the one that we're in. We're currently in a hiking cycle. So we looked at how bonds actually perform when the SARB hikes rates. Apart from 1998, which was also quite a interesting time to be in the market. A lot of things were happening in the world. There was an emerging market crisis. Apart from that chaotic period, it seems that bonds, once the Reserve Bank starts hiking, bonds do well. So it says to us that despite the risk of inflation that's built into the system, once bonds start expecting the SARB to hike to bring inflation down, they start doing well. So this is at least good news, a little bit of good news for us. And we were actually quite positive on bonds at the start of, we were positive on bonds, we were a bit early. We were positive on bonds in mid-2013. And when I joined the team, we were very, very positive on bonds. We bought a lot of bonds into this move. The Reserve Bank hiked. There was a little bit of volatility, but we generally did well from that position because the analysis suggested to us that once bonds get that the Reserve Bank's going to move, the curve flattens, long-end bonds rally, and you make a little bit of returns. Okay, so we've gone to the US, we've gone to the globe, we've looked at where we are in the world, we've looked at what risks we face, and this slide is a critical slide in Prudential. You'll see it in Bernard's slide, and you'll see it in every other Prudential slide that you you come into contact with, but these are valuation anchors. So what are we looking at? On the vertical axis, those are the expected real returns. So we take expected returns for each of those asset classes, and we adjust them for inflation. So over the long term, that gray channel, that's what you expect to get paid if you hold these assets for the long term. So these are what we call equilibrium returns. So that is what you should be getting when you invest in government bonds. You should be getting between 2 and 3.5%. When you invest in equity, you should be getting between 7 and 8% real. Okay? And the red bars are the current market pricing. So this is what we think the market is paying you in real terms for holding those assets. I mentioned we were quite positive in government bonds. So the numbers at the bottom, current valuations. Government bonds, you're getting paid almost 2.5%. And those are 10-year bond yields. You're getting paid 2.5% for taking inflation risk. That seems like a good deal for us. Same thing with company bonds. You're getting paid 4.5% for taking inflation risk, for taking credit risk, and for taking some liquidity risk. So when the red bars are in the channel, those are assets that we think are paying you fairly for the risk that you're taking. Cash, for example, is not paying you anything. But we mentioned uncertainty. At the moment, you'll see in the next slide on the portfolios, we're holding relatively high amounts of cash, and that is because we're cautious. We've taken account of the risks that we face, and if an accident happens, we want to be able to participate in getting assets cheaply. Okay, so our valuation anchors, these tell us what assets should pay you over the long term, and the red bars, what the market is currently telling you, or what the market is currently willing to pay for you to buy those assets. And it all comes together into this Lego block of a chart. So this is the asset allocation for our flagship enhanced income fund over time. It's quite squiggly, which means we change around a lot, and that takes into account changing macro conditions, changing valuations. So Johnny mentioned I would touch property. We were quite positive on property because the valuations were compelling. And property has done phenomenally well over the last while. We're quite positive on property, and we held an overweight position in the portfolio, and once it started getting expensive, we cut it. And we invested a little bit into bonds because bonds are showing good value, but some of it went into cash. So this slide tells you the portfolio is quite active. We take into account what's happening in the world, we take into account what the valuations are suggesting, and we also hold quite a diversified portfolio. So FRNs are just simply floating rate notes. And this is what the fund can do. So these are the gray bars are the strategic asset allocations. So that's the work we do to try and figure out what assets we need to hold over the long term to achieve our goals. And the red bars, the fund's asset allocation as at 30th of April. And there's a bit of a misclassification here. So floating rate notes are classified under CISA as cash. So we hold lots of cash, combination of cash, and floating rate notes because you get a spread for investing in floating rate notes. And finally, my last slide. So the asset allocation really has helped us generate these returns. And we're quite fortunate to have you as supporters, to have you as investors, because you believe in our process, we think the process works, and we're very fortunate to be able to generate 2% of performance over the long term. 2% might not sound like much for my equity colleagues, but in fixed income, 2% when you're getting paid 2% outperformance, when you compare that to getting paid 2% real from investing in government bonds, it's a pretty big deal. So we'd like to thank you once again. I wasn't around for a lot of that, but for the bits that I was around for, I'd like to thank you for your support, and I'd like to thank you for listening to me this morning. And in closing, any questions? There'll be the roving mic. Please email your questions to face-to-face@prudential.co.za or SMS them to 44910. Thank you once again.